So let's go ahead and get started. My name is Christopher Moore. I'm the Chief Marketing Officer of Quiet Light. We help entrepreneurs exit the business for 6, 7, or 8 figures. A lot of what we do is educational. We do conferences, podcasts. We obviously do AMAs and webinars like this. We really work hard to help founders plan for a successful exit. We were founded in 2006, and we are entirely entrepreneur-led and entrepreneur-focused. All of our advisors are themselves entrepreneurs. They've each built, bought, or sold their own substantial online businesses. I think like 90% of them have done all 3. So we're very proud of that track record. But we're also very, very proud to have today with us Sharon Winsmith, who is a tax guru. I don't like that word guru, but I think it applies here. Sharon has a bachelor's from the Moore School of Business at the University of South Carolina. She went on to get a law degree there. She went and studied at the New York University School of Law. She worked for a Big 4 accounting firm. She handled clients from high net worth individuals to Fortune 500 companies. And she's assisted with over $45 billion in acquisitions. So when it comes to tax laws as it relates to buying and selling of businesses, Sharon is the person that you want to talk to. So we're so excited to have her with us, coming to us live from New York. Sharon, how are you doing?
Good, Chris. Thanks so much for having me on. I really appreciate it.
Yeah, I'm really excited about this one. When we started talking about, we had Sharon on the podcast, some of you may know, a couple of weeks ago, and it was a really great interview. And as we started kind of talking about, like, well, we want to go a little bit deeper into a conversation about some of the, upcoming, proposed Biden taxes. I threw out like this very salacious title of, I think something like, is it time to panic, or, something like that, which I like, but we went with a little bit something more moderate in terms of title for this, demystifying the proposed changes in the tax code, particularly as it relates to capital gains tax. But I think that's what is on everyone's mind, is just a worry about, okay, what impact is this going to have on me and my business? Does it change my strategy for when I want to exit? All those things are, should definitely top of people's minds. We've been getting a lot of questions about them. So I'm so thrilled that Sharon agreed to come talk to us more about those. So again, if you've got questions, feel free to pop them into the Q&A box or into the chat window, or you can raise your hand. But we're going to go ahead and get started here with just like a real simple question. So why don't you just walk us really briefly through what's proposed with the capital gains tax and maybe other changes to the tax code that might impact someone thinking about selling their business, or someone who's got a growing business?
Yeah, that's a good place to start, Chris. So as we all know, there's a lot of proposed tax changes in front of us right now with Biden. And one of the ones, I think the one where I get the most questions from my clients is definitely around the capital gains tax. I know, Chris, like you guys have been getting a lot of questions on this one as well. So what's proposed with respect to capital gains is, under current law, capital gains are taxed at a lower rate than ordinary income. So it's 20% is the highest tax rate on capital gains. And there's actually a 3.8% net investment income tax that can apply in some cases. But for all intents and purposes, we'll assume that rate is currently 20%. What Biden is proposing is to actually raise that rate up to the top ordinary income rate for high income earners that are earning over $1 million a year. And so right now, the top individual rate is 37%. However, Biden is proposing to raise that back to 39.6%, which was the highest rate before Trump, lowered the tax rates when he was in office. So what we're looking at under this proposal is that capital gains for individuals with income of above 1 million that year would be subject to tax at 39.6% federal. So that doesn't even take into account the state tax rates, which will add to, in some states like New York and California, can add quite a bit to that amount. But so we're looking at a situation where if you're going to exit your business, you could be looking at paying tax at a federal level of at least 40% on those gains.
Okay, so that's considerable. Is it going to happen?
So that's a good question. And that's one of the most common questions I'm getting as well. So We don't know if it will happen. I mean, there's definitely, Biden needs support in the Senate from every Democrat. We know there's probably not any Republicans that would vote in favor of this. There are some Democrats from more moderate states that have some tough elections coming out where we think they are already pushing back that maybe 39.6 is too much. There could be a situation where they agree to maybe a middle ground. So maybe there is some increase in the capital gains rate, but it doesn't go quite as high as 39.6%. Several years ago, the highest capital gains rate was 28%. So maybe we see something like that come back. But with that said, I mean, he could potentially get this through. He does, if he can get every Democrat in the Senate to sign on and most of the House, then, he could get this through. I do think we expect to see some increase in capital gains rates. I mean, Biden kind of campaigned on that. We can expect taxes across the board to go up. So we don't know if it will go through, but we do expect some increase. I mean, I think a good baseline assumption to make at this point is that tax rates, regardless of whether or not it's an individual rate or capital gains rates or estate tax, amounts that are exempt, those are all going to go up. So we just don't know when and how much.
Right. Okay. So do we have any kind of timetable on when, these negotiations and everything will take place, when it might go to a vote, and then when, these proposed changes, whatever they are, become law?
So we don't know an exact timetable. I mean, so really, we don't know a lot about what's proposed with this capital gains increase. It's really just been, what we've heard about it so far has been from a speech from President Biden and just a short fact sheet that was released. We are expecting what's called a green book to come out with more details around, how Biden's thinking about how this will work. What, how is 1 million calculated, and what does that include, and are there going to be exemptions? That type of thing. So we do expect that to come out. It was actually supposed to come out, I think, this week was the original kind of estimated timetable for when we would get more details on the proposal. Whether or not that does in fact come out this week or next week. But in any event, that should come out momentarily. We'll be able to see more, kind of what exactly Biden's proposing and what the specifics are. And then, I think we're expecting maybe a vote on this summer. But another point that I know is on a lot of, this is the most common question I've got, is if it did pass, when would it be effective? Mm-hmm. And so that's very important, right? Because if it's effective next year, that gives us some time to do some planning. But the answer to that is we don't know. I mean, we like to think that tax increases will be effective proactively. So maybe, starting in 2022. However, there have been situations in the past where they did make, the tax rate increase effective retroactively. So there is a risk it could be for all of 2021. And so if you already sold a business this year, or if you're going to, thinking about selling later this year, it is possible that higher rate could apply. There have been Supreme Court challenges to this retroactive rate increases, and in general, they have, been held to be constitutional. So retroactive tax increases are possible. I think they're harder to get passed politically. So, in this case, where you've already got kind of a tough battle of getting this through, you have to think about that as far as the likelihood. But with that said, I mean, I do think it's possible that you could have a retroactive tax increase, but I would like to hope that it would be effective, going forward in 2022.
Right. And I hate crystal ball gazing, and I don't really encourage it at all. We don't like that at Quiet Life. But I think, do you have a sense of like where this might settle in terms of what, like, the range it might be, or what people can maybe expect, just based on the fact that it's going to be pretty unpopular in a lot of these, constituencies. So there's probably going to be some adjustment.
So, and I mean, I know this isn't a helpful response, but that's hard to say because there's a lot of nuances around this one. So the individual tax rate, that will go up to 39. Like, I think that one will be easy to pass. I think there's other, the corporate tax rate, I think that will probably go up, maybe even to 28%, 28%, could be a little bit lower than that. This one is a little bit harder. There's some kind of attachments that Biden has. I don't know, Chris, if you're familiar with like the step up in basis that you get upon death. So one strategy a lot is, particularly if someone has a lot of investments in the stock market or a family business, they'll pass that on at death, and their heirs will get a step up in basis to fair market value. So there is no gain at that point. So if I've got a business, for example, that's just got a huge embedded gain in it, instead of selling it, maybe I pass it down to my children. They get to step up their basis in that asset on the date of my death. So if they went and turned around and sold that business, there's no gain. So what Biden is proposing, which is really impactful and something that definitely needs to be watched for business owners, is he wants to eliminate that step up in basis. So that could mean if you're someone who owns a business, and I think we do expect some exemptions, because I think we can all, understand where the concerns would be there. If small family-owned businesses, the children aren't going to have the liquidity to pay the estate tax, those types of things. So in that case, that one, that's a big change to the tax code. That's more than just a rate increase. That is a really monumental shift, kind of the estate tax approach that we have. So those are the types of things that I think make this harder to get through. So do I think Biden will get through a 39.6% capital gains rate increase with elimination of step up and basis? I think it's possible. I think it will be a very tough battle in the Senate, but I do think it's possible. With that said, I think 28% is always kind of a rate that economists like, because they think, if you tax people too much, they'll just stop working, or they'll find ways, they'll be more incentivized to do planning or hold on to assets and not sell. So 28% is always a good rate that is a good break even as far as increasing taxing revenues, but at the same time, also not kind of disincentivizing people from selling assets. So it wouldn't surprise me. I know I'm not aware that anyone's mentioned this, but it wouldn't surprise me if we see someone start to talk about 28% capital gains rate. But with that said, again, like, we don't know what will happen, and it will really come down to what Biden's able to get through the Senate.
Right, and just a good follow-up came in from Ted on that question is, do you think President Biden will try to remove the step-up basis on real estate as well?
I do. I mean, so, and real estate's a big one, right? And so I think what Biden's concerned about is, if I raise the capital gains rates, people are just going to hold on to their assets until they die. And anyone that was thinking about selling might, rethink that. And so I think real estate's a big one. I mean, typically real estate is an asset you hold on to for the long term. So I don't see him eliminating that. Also with real estate, there's so many planning opportunities. It's the easiest asset to own as far as planning opportunities to defer capital gains tax anyway, with 1031 exchanges. So I would be surprised if I saw Biden include an exception for real estate. What I think there will be an exception for is farms, small family businesses. I've heard, businesses that are value of $1 million or less might be exempted. So that's where I think you'll start to see Biden have a little bit more sympathy for these kind of small family-owned businesses.
Great. Good question, Ted. Thanks a lot. And a reminder, you can keep popping those questions into the Q&A box or into the chat window. We'll get to as many of those as we can within the hour. So thanks a lot for that question. Next thing I wanted to ask, so given that we don't know a lot, I mean, should people be thinking about selling now in light of the potential increases?
So that's a really good question, Chris. And I also get asked that a lot. So I think there's a number of ways to think about that. If you are someone who was already thinking about selling your business in the next few years, I think the answer to that is yes, absolutely. We know, what we do know is capital gains tax rates are not going down, right? I think we all feel pretty confident that that's not likely to happen in the next few years. So if you are someone who is thinking about selling your business, definitely, I think this is something that should incentivize you to think about, should I speed up the trajectory of that? I definitely, I know from an estate tax perspective, we expect the estate tax exclusion to go down. So I have a lot of clients who are just kind of gifting, up to the current estate tax exclusion now. So with these types of things, I mean, I think I wouldn't necessarily, if you were planning to hold on to your business for a long time, there's always planning opportunities that we can do. So don't think just because the capital gains rate goes up that you're stuck paying it. There is always planning that can be done when you sell your business try to reduce or eliminate the capital gains tax. So I wouldn't just run out and sell my business if I wasn't thinking about it. But if I was thinking about it and it's on the horizon, I would absolutely consider maybe this is the year to do it.
And are there deal structures that people should consider when doing that to like lessen? I mean, I think we'll get into a couple little strategies here in a minute, but are there deal structures that people can look at that are, even like looking down the line, like, oh no, I'm not ready to sell yet, but I want to sell someday? Are there deal structures or things they can be thinking about to help mitigate that liability?
Yeah, absolutely. I mean, that's kind of what I specialize in, is working with business owners to structure their business while they're operating to minimize tax, as well as minimizing tax when you do ultimately exit. So absolutely, there are planning opportunities, there are structures that you can use while you're operating to reduce your taxes, and then structures that, can help you when you go to exit and sell your business. And the sooner you kind of talk to someone like myself or your tax planning attorney that can help you put yourself into those structures, because some of the structures do take some time. There are, like, in order to achieve some tax benefits, you would have to have had that structure in place for a number of years before you exit. But in other cases, there are things we can do at exit. It just, the menu of planning opportunities goes down the closer to sell we get. But I've had people come to me, it's not ideal, but I've had people come to me like, okay, I think I have a potential buyer. I might be selling in the next few months. What can I do? And there's things we can do. As long as you have not signed that LOI or that purchase agreement, there's still planning opportunities that we can talk about that are on the table.
We had one question come in via email beforehand about like, well, I just exited and now I'm like, oh crap, what should I have been thinking about? So are there things that someone can do, post sale to mitigate their tax liability? Or
yeah, usually I get the question of, I've already signed my LOI. Is there anything I can do now? But after sale, so I like to think of myself that I can come up with pretty creative planning strategies. That one's tough. There might, other than reviewing the transaction to make sure that it was treated properly by your current tax person, it's going to be difficult to come up with things that you can do after the contract's signed and the sale's closed, as far as minimizing the tax impact on the gain you got from the sale. There's certainly things you can do going forward to minimize your taxes, and ways that you could invest those proceeds that are in tax preferred ways that can help you, minimize any future tax you're going to pay. But if you've already sold the business, it's kind of difficult at that point. It can't hurt for us to talk about it and just see, maybe there's something kind of unique about your fact pattern. But you really need to get in there before you sign the contract, because once the terms are agreed to, it's hard for us to kind of do our structuring and our planning on that side.
Right. Excellent. A reminder, everyone, if you have questions, drop them into the Q&A window or the chat window. We'll get to as soon as we can. You can also raise a hand. We'll just jump to you and call on you to answer a question for you. Okay, so how should people be thinking about about these potential gains increases more broadly? Like are there things that right now they can be doing to batten down the hatches?
There are, absolutely. I mean, we know, and it's not just capital gains. I mean, we know if you're in a corporate structure, corporate taxes are definitely going up. That I think will happen pretty quickly. Individual tax rates are going up. You may even have other things like corporate AMT coming back in. So we know taxes are going up. We don't necessarily know how much and we don't know when, but we know they're going up. And so there are absolutely things you can do. I mean, in the e-commerce space, you're in a situation where it's difficult to kind of claim business deductions that other businesses might have, because you're not very capital intensive. You don't have large machinery or real estate or other assets that can really help claim large business tax deductions for those. So in the e-commerce space, it is critical that you make sure your legal structure is set up in a way that you're kind of optimizing that from a tax perspective. And then you really need to think about what you're doing with your money on kind of a holistic basis. So, what are you doing with the money that you take out of that business? How are you investing that? You don't want a situation where you're just putting all that money in the stock market, because that's not really or if you're going to do that, we need to structure that properly, because that's not really like the most tax preferred investments. And, gains on stocks are now going to be subject to a higher capital gains rate, as well as that 3.8%. So I don't know if everyone saw, but I think it was CNBC recently came out with an article that was kind of very illustrative, in the sense that if you live in California and New York City, like myself, you're in a situation where your effective tax rate is going to be higher than 62%. So, under a lot of these Biden proposals. So that also, I haven't even, touched on payroll taxes, which are also going up for high income earners. There's some incentives that Trump had in his tax cuts that are going to go away if you make over 400,000. They already kind of do, but they're going to get even worse. So, it's going to be a really bad environment for business owners that are not working with the right advisors and don't have the right structure in place to minimize your taxes while you're operating. And then let alone when you go to exit, don't make the mistake of, not thinking there's something you can do. There is always, there's always options that can be considered. They might not necessarily work for you and for what you're trying to accomplish, but it's worth that conversation to see if there's something we can do.
I think that's a nice little segue into, you put together a little chart for us just about, planning, the importance of planning, and like thinking about, structuring things in a way that because you're saying it's more about the long-term investment and what you do with that money. So can you walk us through, I'm going to share my screen. Can you walk us through this case study real quick and kind of explain some things that people can do to plan better for their, exit and how they invest?
Yeah, absolutely. And so I think what this is intended to illustrate is, I think we all understand when we go to sell our businesses in a couple of years or now, we're going to pay tax on that gain. So, we know we have the tax hit. There's planning we can do to try to reduce that or eliminate that. But, if you don't do any planning, you're going to pay capital gains tax on that gain when you sell. What I think people don't think about as much is what that really means in a dollars and cents perspective, because I'm very passionate about investing. I also, am a passive investor in a lot of different assets. So not only do I think about minimizing the tax I pay on, any assets that I sell, you need to think about your ability to invest the money that you make from the sale of your business in a way that can increase its value to you. So one of the benefits of planning is obviously reducing the tax you pay on the gain. But what's really, I think, helpful is to think about, and this is what this example shows, is so in this case, this is the base case. If you have an e-commerce business owner who sits in California, and let's say they sell their business for $10 million. As common in the e-commerce space, let's say the basis in the business is zero. That's actually not that far from truth. Very little. Most of the time, the basis that our clients have is very low in e-commerce businesses, just because it's not very capital intensive. So at that point, you're stuck with you got a $10 million gain for tax purposes. When you add federal and state taxes to that, you're looking at paying tax of over 3.3 million. So at that point, what you get to take from your business and put in your pocket is $6.7 million. So from a $10 million sale, you're only getting to take home, 6.7 of that. And so, we understand there's planning opportunities to reduce that 3.3 million that you have to pay. But I think what is impactful is to show you the difference where, if I invest the money I make from my business pre-tax versus post-tax, the difference in the value that I can gain from that, over 10 or 20 years. And so let's look at, I think on the next slide, Chris, it was showing what we would get if we invested that 6.7 million that we got from our business sale. So this is just 10 years. And this, I'm just assuming a growth rate of 7%, which is a, pretty achievable growth rate. So I got 6.67 million for my business. I invested that in, let's say, the stock market or something. Every year I'm getting 7% on that. After 10 years, I'll have turned that into 13 million. So that's great that, I was able to grow that money. But let's look at a situation where we were able to, work with you to set you up in a structure where you could defer the capital gains tax on that. So on the next slide, we show where, okay, so I sold my business for 10 million, but I did tax planning. So I deferred the capital gains tax that I paid on that 10 million. So I'm able to invest that 10 million on a pre-tax basis. So if I invest that same 10 million in something like the stock market that's gaining me 7% a year, after 10 years, I've got over $19.6 million. So that's the difference in tax planning and not. It's not just the tax you pay today when you sell your business, it's the amount of money you're going to be able to make from investing those proceeds on a pre-tax basis. So hopefully that's what we are intending to show with this example is don't just think about tax savings, think about your ability to kind of build wealth and the amount of money you're going to be able to make over 10, 20, 30 years if you can do this in a way that you're deferring the tax or eliminating the tax that you have to pay.
Sure. What with these numbers, what really stood out to me is these 20-year numbers. So I mean, if you carry this out another 10, your investment, if you are taxed and you haven't done any planning, is 25 million, which sounds like a great amount of money to get, after 20 years on a $10 million sale. But the 20 years with planning, 38 million. I mean, that's over 50% more. To me, that's like really eye-opening, just how much you can do over time.
Absolutely.
Cool. So someone, Jarrett here, popped a question in the chat window. He said, we're looking to sell in the next few months, and the topic of charitable remainder trusts has come up. Is that a realistic option for people?
It could be. I mean, it's one of the options we would consider. There's other options out there, and it really just depends on what you're trying to achieve and what your goals are. If you're someone that is kind of very charitable minded and wants to take, I would say a charitable remainder trust is a more simplistic, like less complicated way to structure the sale. But if you're someone that is happy to donate that money to charity, then that's absolutely one of the tools you could use. There's other options out there, and it's just a matter of what makes the most sense for you and kind of what your objectives are. So that's kind of what I do. So if you came to me and we talked about, what are the options that you could have for to structure the sale of your transaction, charitable remainder trust would just be one of many options that you could consider. And there are options out there because with the charitable remainder trust, you are required to donate at least 10% ultimately to a charity. And there are some options out there where you don't have to do that. You don't have that kind of charitable donation requirement. So again, it just goes back to what are your goals and objectives? But you want to work with someone who understands what's out there and talk to you about all the options on the table, because I kind of get there's two strategies. People say, what about charitable remainder trust? And then sometimes I get a lot of questions from clients about what about qualified small business stock, exception for 10 million. That's another one I get a lot. I get ESOP trust, a lot of people asking questions about that. Those are options. Those are on a menu, but there's a lot of other options that might make sense and have, bigger savings for you if they're taken into account.
And what would you say kind of to, because a lot of e-commerce sellers, they're not taking a lot of money out of their business. They're putting a lot back into inventory and to that sort of stuff. So, I mean, they're really excited when they get to that big exit. They're taking out a big chunk of their money. We talked about some, investment strategies. How can someone both invest and, take some money out of the business, finally realize some benefit from, all that hard work? Because, I mean, more than 50% of, the amount that someone will earn over the lifetime of the business, they earn at exit. So.
Right, absolutely. And you're exactly right. That is what we see mostly with e-commerce businesses. So there are ways. I mean, if you want to start to take money out sooner rather than later, you can do that. And then we want to make sure we do that in a tax efficient way. But if you want to leave the money in there and grow, which is what we kind of commonly see, and we need to take that into account in your structure. We want to make sure that you're not being kind of penalized for that, because the last thing you want is to be paying tax on earnings that you're just putting back into your business. If we can avoid that, that is very difficult in the e-commerce space. So you need to make sure you're working with someone that can really kind of talk about the planning opportunities that are really on like the more sophisticated level of planning that's out there, it's not as easy as kind of, setting up an LLC and treating it as an S corp or something like that. There's really more that comes into play here. As an e-commerce owner, you're kind of in when you look at the scale of business owners, e-commerce businesses, I think, are the most difficult from a tax planning perspective, just because you don't have those kind of heavy capital assets that a lot of other businesses have.
Great. So you mentioned that it takes time to do this planning, especially if you want to, and there's some strategies that need years, you even said. So what's a reasonable time frame for someone to think about, like, okay, I'm feeling like this thing is is going to be something I want to exit in 2 years, 6 months? Like, what's a good time frame? What can they be doing? What should they think about now in regards to the exit?
So I would say as soon as you're able to make the investment to work with someone, an advisor that can help you with this. And it's not, I think people kind of have a misconception that it's very expensive. What I do with my new clients is I do a tax strategy for them. And that would include, reviewing their business and telling them what structure they should be operating through, and talking to them about their investments and how they can make investments in a more tax beneficial way. But it's not, the minute you're able to make that investment, you should do it, because the worst thing you want is to be paying more taxes than you need to be. And so every year you don't do planning, you're paying more tax. And I always joke with my clients, wouldn't you rather pay me than, Uncle Sam? So I think, the minute you're able to make the investment to work with an advisor to do a strategy, then you should do it. Because even if you're not making a lot of money in your business because you're just starting, the first year you do start to make a profit, you're going to pay that away in taxes. So it's critical that you do it sooner rather than later. And then, as I mentioned, there are some structures that do take some time to kind of bake. And so you can't just, if you come to me and you're going to sell your business in a couple months, there are certain structures we can't consider at that point because there just isn't enough time, or there's certain requirements in the tax code that we wouldn't meet. So the sooner we can talk about that and, get you in the right structure, then the better. So I would say, the minute you're able to make the investment of working with someone on a tax strategy, you should do that.
Yeah, and outside of like working with a tax professional, like, what's the number one mistake most entrepreneurs make in preparing themselves for, like, lessening their tax burden, just normally, or even when they're exiting?
I would say the biggest mistake I see is not working with the right person. I think a lot of people just pay they'll pay a CPA $1,000 to prepare a return, and then get like disappointed that CPA wasn't bringing them, planning solutions and that type of thing. So I think not partnering with the right tax professional, but also not having the right structure in place and not taking into account your kind of specific tax. Like I have clients that come to me and they're like, well, I read a book that I should, switch to an S corp when I make $40,000 in net income. Well, that doesn't make sense. That doesn't even make sense to start. And it doesn't make sense for everyone. I mean, if you're an e-commerce business that thinks you're going to IPO in the future, then we should start thinking about a C corp structure. And if you're someone that wants to reinvest your proceeds, maybe we need to put a C corp structure in your structure somewhere so that you can do that on at a lower tax rate. So I think not having the right structure and not kind of appreciating the value of working with advisors that can help you get there and, help you, because a good advisor pays for themselves, right? I mean, my business coaches and the advisors I work with, within a year, they pay for themselves like, tenfold. So I don't charge my clients if I can't recover tax savings for them. And I think any good advisor would have that same guarantee. So in my mind, the two biggest mistakes I see are not working with the right advisors and not being willing to make the investment. And then second, not having the right structure in place that can help them accomplish their business goals in a tax, beneficial way.
Right. And I see this a lot with, quiet like clients. It's like there's a certain amount of fear that goes into, dealing with taxes, but I think there's a big payment on the back end if you're being too fearful of what you need to do. One thing that we see also a lot of is just like, people haven't normalized their P&Ls, or everything's in Excel or whatever. What do you need to look at when someone comes to you to like to be able to, quickly like get to the heart of, where they're at and what they need?
Yeah, I mean, I can actually glean a lot of the information I need from your most recent tax return. So that's always a good starting point because that'll tell me a lot of, what your tax position is, what your structure looks like. And then just if a business has projections, most of my clients do not have, good projections to work with. But if you're someone who does, then, that's always good for me to see because that shows me what we're looking at over the next few years. And then just understanding kind of what your business objectives are, what your path to growth is, what your intended exit is, what kind of what are your cash needs to fund your personal lifestyle, those types of things. And then it's after that, it's pretty easy to put a strategy in place that can help you do this in a way that's very manageable.
Great. And so then I guess when should someone reach out to you or to another tax professional when they're thinking about exiting or even wanting to know what their options are? I mean, I know as soon as possible, you said, but yeah, like if they are worried about what's going to happen in 2022, but they need to get some things in order, like when's like the latest they can do that? How long does it take you to put things together? Like when someone reach out to you?
So if you're thinking about exiting anytime in the next few years, you should definitely reach out. I mean, if anyone should reach out now as far as, coming up with a strategy, but if you're thinking about exiting and you're curious about what the alternatives are out there, then you should reach out as soon as possible because the further you get down the line as far as negotiations with potential buyers, the less, opportunity there is for planning. So you want to reach out. We want to get you in that structure that we want. If we want to set up a trust, for example, we want to do that. And we also want to know what we're going to be expecting from a buyer. I mean, in some cases, you might need the buyer to agree and sign on to some things, or in some cases, we might be willing to take a reduction in the purchase price if we can get the buyer to agree to, structuring the deal in a way that's advantageous to us. So as soon as possible, because the worst thing is you've already signed the contract and there's nothing we can do at that point. So, the sooner the better. And just to have a conversation with me is free. So I'm not going to charge you just to get on the phone and talk about and see, if it makes sense for us to do a strategy and help with exit planning.
Sure. Are there types of buyers that people should be more receptive to or looking more toward that are amenable to deal structures?
There are. So I actually find that so if you have a buyer that's going to get financing through the SBA or banks, which I know is less common in the e-commerce space, that can be more difficult as far as, being able to kind of negotiate the structure of the deal because you're kind of stuck with SBA. They're going to want it a certain way and you're not going to have a lot of wiggle room there in our experience. But if you've got a cash buyer, it's a negotiation point because what's good from you as the seller from a tax perspective is usually detrimental to the buyer. So it really just comes down to, okay, I might be willing to take a hit in the purchase price, reduce that a little bit. If you'll, agree to this structure, that'll help me on my taxes. So that's what comes into play. And, to the extent you're working with a buyer that's more sophisticated, really understands what you're trying to do, then they're usually willing to work with you because they want the same when they turn around and sell your business they're buying. So I find the more sophisticated the buyer, better it is as far as to get them to work with you to structure the deal. The other thing I'll say is a lot of our planning strategies don't involve the buyer at all. And so, those are great because then it's just, the buyer might not even know what you're doing, to be honest. So those make it a lot easier as far as, getting the buyer to agree or negotiate the deal structure.
Sure. And I mean, just stepping back to that for 1 second, like what about private equity buyers? I know we've got a lot of aggregators and private equity in the marketplace right now. Are they pretty amenable to deal structures that are advantageous, or do they really want you to take a bigger hit in sales price for better deal terms?
So, well, I think a sophisticated buyer is probably going to want to negotiate the purchase price if you're going to prefer a deal structure that's not preferable to them. So I think anyone that knows what they're doing would expect some sort of, some sort of negotiation there at that point. But I know a lot of my peers would not necessarily agree with this. But in my experience, PE buyers are very easy to work with, and they're actually usually the easiest. A lot of it's because of lack of financing restraints. But in my experience, I find, private equity is very amenable to helping you because they get it, they understand what you're doing and trying to accomplish.
Great. That's awesome. Well, I guess, we've blown through a lot of questions. I thought it would take a little bit longer to get through all those, but I guess the biggest question is like, if someone wants to contact you, how do they do that to kind of get more information?
Yeah, so you can go to my website at winsmithtax.com, and there you can actually schedule a free consultation with me, and we can talk about your situation and see if there's anything I can do to help.
And on our side, we obviously love to have conversations with entrepreneurs about the value of their business. We recommend Sharon and a few other tax attorneys as well. So it's kind of a both and type situation as far as we're concerned. You want to be thinking about what do you need to be doing to get your business ready to sell. So we, help by giving a free valuation and business analysis, understand like the levers that are driving the value of your business and help you like understand what you need to do to get it ready to sell. And then, people like Sharon can help you, understand what tax things you can be doing. It's a pretty labor intensive thing to sell your business. So, and it's emotional, it's hard. So, but we just really encourage planning at every stage of the sales process. So so reach out to us at Quiet Light. You can reach out to us at I'm the Chief Marketing Officer. You can reach out to me, of course. It's Christopher@quietlight.com, or you can, if you just have an inquiry, want to do an evaluation, you can go to quietlight.com/sell or email inquiries@quietlight.com. And then we'll be placing this video on YouTube, on our website as well, so you can refer back to it. And certainly, we'll give our hearty endorsement of Sharon and her services. So she's been awesome to work with, and we brought a lot of value to our clients. So thanks everyone for your questions and for joining us. Sharon, thank you so much.
Thanks, Chris. Appreciate you having me on, and appreciate everyone joining.
Yeah, do you have any parting shots?
No, I think just make sure you work with an advisor when you're selling your business, because there are some promoters out there that will try to sell you some structures that can, be very risky and can also, have some criminal penalties and even in some cases land you in jail. So it's important that you make sure you work with a non-biased advisor that's not incentivized to kind of sell you something that's going to make them a lot of money. So that's kind of what I do. I work with my clients to assess the options and tell them which I think is best for them.
Great. Awesome. Well, thanks everyone for your questions and your participation. We'll see you for our next webinar next month with Paul Anderson. Thanks a lot, Sharon.
Thank you.